Mark, and gee, great to see such a huge audience here. So big I had to give up my seat, actually. So we've rolled another table in down the back there, so fantastic, Sydney. Well done. The headline here is the bottom line. I'm going to start with the headlines, actually.
More than half of Australia is being pushed to the financial brink.
What's been described as the perfect financial storm.
The Australian economy could actually fall off a cliff.
We need a rate freeze now.
There's certainly a downturn coming, really, when these interest rate rises start to bite.
When I go and see clients around the country, I actually get asked, Don, tell us some good news, because all we hear on the news, turn the telly on, is all this doom and gloom. So I'm going to tell you some good news. I'm not going to say everything's rosy, but I don't think it's as bad as what we see when we turn the TV on or read the paper, because bad news sells papers or makes you want to watch the show. So what are the good things? Well, we've got full employment. And if you've got a job, you pay your mortgage. So yeah, there's a bit of mortgage strain out there, a lot of strain for some people, but if you've got your job, you pay your mortgage. And if you actually go back to the recession we had to have, and I was in the markets at that time, it wasn't people defaulting on their mortgages, it was the huge companies, the bondies of the world that made the banks go nearly belly up. I was a Westpac, and Westpac almost went broke, actually. I had to stay at the Novotel on Collins for quite a few years because they were mortgagee in possession. Cash rates are high. Well, no, not in a long-term sense. We just got used to that stupid 0.1% interest rate. That was the silly thing. So I got a long-term thing in the future. Inflation, high, but it's coming down. It's already peaked. It was 7.8. It's now actually, well, if you believe the monthly numbers, 4.9. Corporate balance sheets, by and large, are strong. Yes, interest rates are rising, but they didn't go out and borrow ridiculous amounts of money when interest rates were low. House prices seem to have stabilised in most of the country. They went down a bit, but they seem to have come back. So Chris Joyce hasn't been able to talk that market down. And many borrowers are ahead on repayments, and a lot of people have got money in offsets. And we've had a couple of pretty good financial years, bookending a pretty rubbish year. So yes, 2022 calendar year, or the financial year 22, was pretty poor, but 2021 and the last financial year we've just finished were actually quite strong. 2021 was the second best on record. So, you know, average them and it's not too bad. Now our focus is on retirees, as Mark said, and retirees are different. They're living now off their income from their investments. They're worried about longevity risk. They've got one thing on their side though, they still are tax-free, at least for the first $1.9 million, and that was indexed up. And we try and take advantage of that, and we try and generate high levels of income so that our retirees or our investors can hopefully live largely off the income from their investments rather than have to draw down on capital. And it's got one comment on tax, and this slide here, or a couple of comments on tax, but this slide here highlights why we focus on retirees and why retirees are different. We're looking here at the after-tax value of $1 of pre-tax income, and the first set of lines are for retirees, and the black line is the value of a fully franked dividend. If you get a $1 fully franked dividend, it's worth over $1.40 when you get the franking credit refund, and you still get that refund. So for retirees who are in that, self-managed super funds, or even in non-self-managed platform funds or what have you, if they've got their money in tax exempt, they get a full refund of those franking credits, and they're very, very valuable. And that's what we focus on, generating high levels of fully franked income. It's still pretty good for super. And the other thing that the government has done, they've made a few little changes on tax for retirees and things. They are proposing a tax, another 15% tax on people with a super balance of more than $3 million. Now, we don't feel too sorry for people with a $3 million super balance, but within 30 years that will be equivalent to a $1 million super balance today if they don't index it, which is what they're proposing. But nevertheless, our fund will still be good for those investors that have more than $3 million, because fully franked income, the black line, is still going to be more valuable, or the most valuable income or after-tax return for those investors. We have written a paper on it for if anybody wants to talk about it. There's a few other issues that are very interesting there. But before I hand over to Pete, just I said interest rates really in the long-term sense aren't that high. Well, look at this chart. Yes, they're a lot higher than they were a year or two back, but actually in terms of that long-term trend, they're not that high at 4%. It's just we got reduced to very silly interest rates. And a lot of people are saying, great, I'm getting some money on my term deposit, I'm now getting like 4%, and bond yields are about 4%. Well, here's the bad news if you're thinking about that, and it's still the case. When we adjust for inflation, even though inflation has peaked and is trending down, you are still going backwards. If you've got $1 million in a term deposit generating about 4% interest, and inflation is running, what, 4.9 or 6%, you're actually going backwards. You're losing money. So the safe assets aren't all that safe at the moment, and with that I'll leave it to Peter to talk about the markets.
Thanks, Don. So yeah, I'm going to talk a bit about market update, and particularly with regards to the reporting season that's just gone by. So overall, it was a pretty decent reporting season when you look across the board. The median increase in dividends on that right-hand chart was 4%. That's the one we usually focus on. The average one's a lot higher, but that was kind of biased by a lot of kind of really large increases from some small stocks. But it was interesting to note that when you look across the market as a whole and market cap weight these kind of dividends in terms of the total dividends that were declared, it was actually 21.2% less than last year. And that's because of some big dividend cuts from some miners, which I'll go through in a little bit. So where did we see the strong dividend increases? Well, the biggest area was actually in the insurers, and the reason for that is that we obviously know that Australia went through these 3 years of La Nina and they had very bad claims during that period. But since then, we're actually moving into an El Nino period, so claims are starting to go down. As interest rates are going up, that's increased investment income for insurers because they collect the premiums, they then invest them before they make their claims paying out. So we're actually seeing increased investment income, and then during that time of La Nina, they've been able to increase their premiums significantly by about 10% per annum. And so that's meant that their future earnings are looking pretty good. So we kind of like the insurers at the moment in the current market. We also saw a good dividend increase by Commonwealth Bank of 14%, which I'll talk about in a moment, and Medibank Private also increased their dividends. The retail sector also held up a lot better than the market had expected. Lots of people had expected doom and gloom as we talk about this looming cliff for earnings, but actually the retail sector held up pretty well, and you saw stocks like Super Retail Group had a 60% increase in dividend, which included a special dividend that they announced. 2 companies cut their dividends, both of them got smashed, so it shows the kind of benefit of watching out for dividend traps. That was Costa and Iress. And we also saw big dividend cuts, as I said, from the big miners. And that was largely because the iron ore price in particular fell very strongly from where it was this time last year. Now it seems to have stabilised and is even increasing a little bit from those low levels, so their half-year numbers were quite good compared with the last half. But when you compare it on a full-year basis, there was actually pretty significant cuts, so 52% in the case of BHP, 32% for Rio. And we also saw some other cuts from some of those dividends. So when you look across the board, 57% of companies increased their dividends, 13% had flat dividends, and 29% reduced their dividends, which is slightly higher than normal in terms of companies reducing their dividends. So in terms of CBA, it was a pretty good result. Profits are up 6% on last year, but actually down 3%. The interest margins coming out of the banks actually peaked in October 2022, and so have fallen a little bit from that period. And so even though profits only increased by 6%, we actually saw a 14% increase in dividends as Commonwealth Bank upped their payout ratio. And that's largely what we expected, given when the government have announced that they're not allowing off-market buybacks anymore. Commonwealth Bank were a kind of bank that did an off-market buyback roughly every 5 years, and now they can't do that anymore. They're likely to increase their payout ratio in order to move those franking credits off their balance sheet and into their investors. So that was a good result for a CBA. JB Hi-Fi, one of those stocks that the market had expected to cut earnings strongly. Well, it actually turned out their sales were up 4.3% for the year. Earnings were flat on last year, which is a pretty good result given all the pre-COVID kind of spending that we were doing. Their dividends did decrease by 25%, so they're a little bit conservative in that regard, but their annual yield is still 9.6%. So it shows you how cheap that they still are, that the market is not forecasting these earnings to continue for them going forward. And while July like-for-like sales did decrease a little bit, they were still relatively strong. So Woolworths was next. They had a 9% increase in dividend on a 13.7% increase in profits, so they held up very well. They actually outperformed Coles very strongly during the period, where their margins actually went up while Coles went down, and so they're a very well managed business. Their food sales are still holding up very well. Obviously they're very defensive, and that's why they trade on a low yield of around 4%. When we look at BHP, so profits were down 37%, dividend was down 54% as they increased their CapEx requirements for future years, but they still are on a dividend yield of 8.6%, so it's still looking very good for them, and their payout ratio is just 59%. So it's still a very good result from BHP, and actually called out something that the market isn't too focused on at the moment, which is that while the iron ore demand from China has been kind of stabilising and people are worried about that, the iron ore demand from India is actually going up as steel production in India rises after Modi has come on board there. So good demand coming from India. And then lastly, Woodside Energy, whose profit was up 4% on last year. Their dividend was down 27%, but when you take into account the merger that they did with the BHP that allowed them to pay an extra dividend last year, their actually base level of dividend was up 5%, and that's a 12.8% dividend yield. So you can see how cheap Woodside Energy is in terms of the current levels of dividend they're paying out. So I'll hand back over to Don, and he'll
Thanks, Pete. So we talk about the bottom line. I'm going to use this chart to talk about the bottom line. So where are we in the dividend cycle and what's the outlook? This chart looks at the probability of a dividend cut across the market. Now, high is bad. If there's a high likelihood of dividend cuts, that's very bad, and you can see there was a peak in the pandemic when this indicator got to 45%. This is a number-driven thing. Then we realised that the COVID wasn't that bad and it actually fell to below average, and that was when we were calling out big increases in dividends a couple of years ago. And we saw those big increases, but what we have seen in this indicator, it has ticked up for the last 18 months as interest rates have risen. But when I say it's ticked up, it hasn't shot up. That grey line across there is the long-term average. We are only just above the long-term average. So yes, things are a bit more uncertain, things are a bit tougher, but from a company perspective, it's still pretty good. We expect to deliver a 9% yield this year out of our fund. Thank you for listening.